The head of research at Afinvest, Robert today is here on the Market Street, unpacking a few of these very interesting conversations from the macro economy on one side and the corporate fundamentals, then some sectors and stocks to watch. Robert, let's continue that conversation. And let's put the budget a little bit aside and go straight to the Market Street. Where are the fundamentals of funds flow dynamics right now? Equities, yes, fixed income, we have the mutual funds and whatever. Do you think with the way the broad equities market is falling, as it were, or sinking, do you think there's a need for everyone to begin to take a second look at what the realistically indexed return will be for this year? We lost 37,000 again yesterday.
Correct. Yeah, you know, again, during half year, we had reviewed our earlier position where we projected the market will return 18%, you know, and looking at the factors now, particularly fund flow dynamics, you know, policy normalization in systemic central banks, you know, with the US Fed still promising another 2 rounds of rate hike before the end of the year. Clearly, most investors would want to, you know, pitch for safety, you know, which is why we've seen the run on not just Nigeria, but other emerging market, you know, assets. But when you look at Nigeria, it's peculiar because this is an economy that is just recovering. The rate of recovery has been steady, but it's been sort of suboptimal, you know, when you look at where we should be normally. But again, the fundamentals are not really the issue pressuring the market.
That's the issue. We have very strong macro fundamentals.
Well, strong.
So
strong,
what?
We must use strong advisedly, you know, and this is why I said it advisedly, because in terms of macro indicators, this is not where we should be, you know.
As a country,
again, there is stability, you know, and that's the much of what we should talk about. The macros are not strong. You know, if you see any form of other oil price shock, you know, should you be waiting for the next oil price shock?
But the IMF Economic Outlook report 48 hours ago says we should be looking at a better 2019 in terms of our GDP growth, revised a little bit upwards.
Well, IMF, we always have their reasons, you know, but we are here, and when we look at the indicators, we look at things to look out for government efforts, you know, to boost spending, you know, the expenditure pattern of government, which we've often reiterated is, you know, government is running this large budget that is, you know, again, not supported by the basic fundamentals, structural reforms that we need to do to catalyze us to double-digit growth, even, you know, better than what we had in the pre-2014 level. We're not seeing all of those yet. So again, stronger growth is relative. If you recorded 0.8% in 2017 and you do another 2% in 2018 and then you do 2.1 in 2019, it's stronger. But is that where you should be? Definitely not. You know, again, we will differ with IMF on that projection. I mean, for us, we're looking at a situation where we begin to get to that level where the economy was recording on a consistent basis, at least before 2014 crash, you know, trace back 10 years before 2014, we're doing nothing less than a 5% growth.
Do you think those growth, with some folks, was not inclusive? Not everyone was on board. It was growing in the pockets of some people.
This is more. The current growth we have is even more non-inclusive, you know,
than the previous one.
Than the previous one. So, I mean, look at how do you measure inclusiveness? You know, Nigeria is currently the poverty capital of the world. You know, meaning that GDP per capita is lower. You compare us to Kenya. Kenya has a better GDP per capita than Nigeria. You know, so when you talk about inclusiveness, the indicators to look at for are even worse now than they were previously. Sure.
So when investors are caught between these strong fundamentals, fundamentals, macroeconomic fundamentals, and corporate fundamentals for some sectors like consumers, insurance, and what have you, and they have to decide what comes first, the stomach or the stock market. Again, how should I spend my money? My stomach or the stock market?
The drivers of the market, you know, the current equities market structure, as we have it, are the institutional base. What do I mean by institutional base? The drivers of the market, again, when you put your funds into the market, you're putting it with the expectation that prices will go up. Nobody puts money when you're sure that prices will go down, you know. Again, you can say you're betting that I'm buying this stock, prices
because
will
it's
go
going
up.
up.
I buy low and I sell high. That's the the tenets or the fundamentals of investing, you know. But the issue here is that the institutions have always driven our market, and the institutions here are more tilted towards the foreign investors, you know, foreign investor institutions, you know, than the locals. So when you're betting on fundamentals of the corporates, we must say that the corporates have been resilient. You know, this is an economy that is really challenging to operate in, you know, but again, corporates are resilient. You know, you check across major metrics from the recession of 2016 when most of them, you know, suffered setback. Fortunately for them, some of them even recorded higher revenues because they had to raise prices, you know, and the elasticity of those products, especially in the consumer goods space, allowed them to pass them through to the consumers. Though volumes dropped, you know, but revenues were up and earnings were, you know, somewhat upbeat as well. But we are having a situation now where fundamentals still remain that resilient, you know, in terms of growth, although there are still challenges in terms of finance cost, again, traceable to the inflationary pressure.
So resilient is the word. Resilient. But not that it's really strong, but it's resilient.
It's resilient.
It's there, it's holding up.
I mean, again, see, for instance, when you look at the consumer goods space, there are two indicators. So when revenues grow, you're looking at the price and you're looking at the output, you know. Prices have shot up by over 50%.
Of goods? Yeah,
prices of goods, you know, and even raw materials, which producers or manufacturers were able to pass to the consumers. But outputs have dropped. So if your price grows by 50% and your output drops by 20%, net revenue will be up, you know, but you're actually worse than you were before because consumer spending power is pressured.
You're just being resilient. Not that you are firing on all fours.
Exactly. And then the resilience is traceable to the nature of products. If it's a necessity, you know, and I mean the structure of the industry. So is it an industry that you have few players such that when they have to change prices, the kickback, the protest from consumers in terms of demand,
yes, or demand,
is really not as
strong enough.
It's really not as impactful.
Yes,
you know,
as the price.
Given that they are necessity products that consumers really need.
Yeah, so you can afford to do something with your price.
Determine whether you can afford to increase your price, but what will now determine whether consumers want to play there, you know, will now be their income level, which is another issue. You know, the fact that, you know, salaries are not rising, inflation is rising, so disposable income is, you know, contracting and shrinking, and this again is going to affect their powers to be able to, you know, continue to.
So do you